Chris, how are you? Doing busy? I had a lot of calls today. There has been a significant, I actually had a interesting post, a bold post to help at least 15 people before the end of the year. I already got my 15 in just 2 days.
Awesome.
So that's been a great journey. Now, as a matter of fact, I feel like there's a big non-immigrant population. We're probably going to have a non-immigrant session as well,
Sure.
just so that people can understand. And also, a big interest is for the Canadian folks who wants to do business in US.
Mm,
So there has been a lot of search, a lot of Canadian folks. I think I've recently connected with three individuals, at least, who have been Canadian citizen, but they want to invest heavily into the real estate and the businesses in US, which is a great opportunity for us. So I thought we might someday also focus on that a couple of episodes today as well. Not today, in the future.
of course. Let's do it.
Awesome. We will do that. So people from Canada, if you're tuning in, if you're planning on doing your business in real estate or real estate in US, feel free to reach out. Even if we don't know everything, we'll figure things out. So, but for today, we are still running our real estate deep dive. We are now moving. I know we have spoken about the active versus passive up until the last one as well. We had spoken about a lot of the scenarios in depreciation. We're probably going to go a little bit more into it in this one. But before that, one of the traditional ones, which a lot of courses from a lot of people has been out there, is to flip houses.
Yep.
So let's talk about that for a second. So the concept of flipping houses, you buy it low, buy a beaten up house, fix it up and sell it for a profit. Okay. Typically it happens is most people use hard money or private money loans to buy it, or even at least put the down payment for that. So Chris, help us through what are the things typically you have came across.
Well, I mean, really what happens with it, it's almost like you're buying stock and trying and hoping that it like increases in price. And
Mhm.
that's what you're doing. You're hoping everybody, there's a huge, and there still are a lot of flipping shows. I still remember Flip This House with Armando Montalongo. Don't mean to give him any more press, but there we are. But what it is that you're buying, let's, as you said to, so if you're buying a house, you put some money down or you bring in investors, what have you, and then you hope to sell it for a lot more than what you bought it. Now, what happens is that you're hoping to have a big gain on it and pay capital gains on get capital gains on this and pay capital gains taxes. So what happens is that you'll have the sale price and then you'll take out the purchase price plus the cost to fix it up. And that's going to give you a gain, the gain that you're going to recognize on there. Now, the thing about it is that most of these flips you're going to turn around within what, 60, 90 days?
Mhm.
So you're going to have, it's going to be at short-term rates, which are much higher than long-term rates. When someone comes to me and they're thinking about, they just moved in a house, I don't like it, and like, well, I want to get out of here, I want to get rid of this rental property. Well, can you hold on to it for maybe one more month, and then it will be long-term, and the capital gains rates are much lower. So what's happening is that you're hoping to make enough money that the capital gains taxes are going to be a lot, will be insignificant to the amount that you're realizing on it. And as we talked about in past shows, don't necessarily focus on the taxes, focus on the money that you're going to make, and the taxes will kind of take care of themselves.
That's awesome. A couple of things you brought up is, first of all, just for the regular folks, is the intent. So if you intend to hold it for a profit, it's called capital gains. If you are just buying it and just your main intention is to flip, then it becomes an inventory.
Yep.
Just like if there is no pretty much difference between flipping a car versus flipping a house or flipping a couch, which Ron Pineda a lot of the times preaches as well. But what Chris has mentioned is really interesting point is if your intention and your intent was to rent it and you came up with this very offer that you couldn't resist. Like we had the situation early COVID. People wanted to hold it, and all of a sudden, the appreciation in 6 months went twice, almost 80-90%. That's humongous. That's not very common in our flipping industry, but it was there. So in those cases, we're still going to be recognizing short-term capital gains,
Yep.
which is as equal as the regular tax rates. But if your intent was to flip, remember this is going to be a sales process. It's just going to be an inventory, not a capital gains. Stating that, let me ask you this, Chris, is say, for example, I bought a property in September and I fixed it up. By the time November came in, my fixing is done. I put it on market in December. I go under contract in December. So when you said 1 year, is it one taxable year or actual one calendar physical year?
365 days.
Awesome. So that means it would be recognized as a short term up until next year's September.
Yes.
Okay. So that's an interesting point, folks, is when you are going to be having a property, if you are thinking about that capital gains aspect, which again, just to clarify, your intention was to rent and make money out of it.
Yep.
What you did is you thought, hey, I'm going to pay taxes on that one. No. Since you have been holding it since September, you can take that capital gains the following year because you need to hold up until next September. If you go into the under contract in December, close it in January, it's not going to count. It's going to still be a flip. We're still going to be recognizing regular. If your cash method, which if you have not seen our other video on the accounting, if your cash method, if your closing happens on 31st of December, but you get the funds on 2nd of January, if you're a cash method guy, then you're going to be recognizing it the following year. If you're accrual method, then the previous year.
Yep.
So if you have more questions, reach out to Chris and I would love to help those out.
Absolutely.
Now, let me make it a little creative. It's going to be, as you know, that I am the creative dumb guy coming into the Novation, which is pretty much instead of buying it, what I'm trying to do is I'm partnering up with the seller itself that, hey, you and I am going to be coming to an agreement that I'm going to fix it up and we're going to put it market and we have to sell. That contract is going to be abiding us legally to sell it. And in that case, you are going to be paid, the seller is going to be paid from the proceeds of the sale. What happens in that case, Chris?
Well, so with the Novation, what's happening is that you're replacing one lendee with another. And what happens now, we got to be careful there. I'm going to backtrack a little bit too. So if you said the salary taken from, we need to be careful when talking about it. You're not being paid a salary, you're going to get gains on that. So we don't want to have people thinking you're getting a W-2 when they're flipping a house. I've never seen that. So, but what's going to happen is that the IRS is going to take a look at the transaction. So if it really is going to be the nature of the transaction, did you do this all at once? Or did you do it over a series of payments? And that would become an installment sale, which we can talk about on a future podcast.
I think we spoke about that on episode 5. So if someone has not seen the episode 5, go back and see the episode 5.
Absolutely. Take a look at that. So we'll take a look at that. Then the IRS will say, okay, so what has happened with this and what gain did you get out of selling your lending, being a lendee on that? So that's what they're going to take a look at. So when you're sitting down and drawing up the contract, then don't just go with your partner's lawyer, get your own lawyer because you are looking out for you. So
Absolutely.
don't assume someone's gonna, your partner's gonna take care of you. No, they're not. Make sure you're taken care of. So always sit down and
Absolutely.
say, all right, so what's going to happen? When does this switch out? And then that I am relieved of it. And how much do I have to gain on it? If you don't have any gain on it, you're not put in a better place. The IRS says, okay, well, that's nice. No taxes for you. But if you do see and you have a gain on it, and then you picked up some cash, or the loan was forgiven, then the IRS is going to look at you and say, all right, you're going to owe some taxes on this. So Tusuf's got the whiteboard out here, and he's going to start illustrating something. So Tusuf, go to work.
Awesome. So just to summarize what Chris has been showering us with the knowledge is, one of the biggest things Chris mentioned is if you're replacing one loan with another, if that loan goes away, that is considered as an income. Forgiveness of loan is an income in the regulation of IRS.
Yes, it is.
So doesn't matter what, you need to consider that. Okay. Now, in terms of when you're flipping, what happens is you need to buy it first. Oops, the color is too bad. You need to buy it first. But in Novation, the ownership doesn't change in the first place. So here, there's two transactions. So one from the seller to the flipper, then the flipper to the end buyer. In Novation, the only thing is between the flipper and the seller is just one piece of paper that is a contract that legally binds them. Hey, if I do flip it, if I do put all my money, you cannot say that, yo, I think my houses look beautiful, I cannot sell it. That's not going to happen. That is when it becomes the aspect of that loan. If they say that, hey, okay, I think I'm going to keep it, that's not going to happen, then they need to pay you, whoever the flipper is. In that case, that's going to be another thing. It's going to be a payment. So reduction of loan becomes a payment in the IRS, as Chris was mentioning. So now, with all those legal shenanigans, now here, there's one single transaction from one to the second buyer. But the difference is, you can potentially take this as a capital gains, but this one you cannot, because a flipper never owned the property in the first place.
Exactly.
And for however the period of time there was holding it, there was an ownership. So if you're like, hey, I want to treat this as a capital one, then you can take depreciation in it. In this one, unless the actual owner is taking depreciation, there's no depreciation for the flipper.
Yep.
So these are some of the fundamental things that you need to be considering when you are doing a novation or a flip. And sometimes some people do it with trusts as well. And also I will see if you have other loans. Just make sure when you're removing those loans, how many loans are there? Who are those loans? And if you have not seen our previous episodes where we spoke about private money lending, make sure to have that, because sometimes people do take care of or secure their loans, private money loans, as second position liens and stuff. And in those cases, if you have a second position lien here as a flipper, if that goes away for any reason, if you're paying them back from the proceeds of the sale, that becomes an expense or loan payment, repayment of a loan. But in this case, you never owned the property in the first place. So whatever goes through, it becomes also a thing, but the difference is here, it becomes through the seller. It is through the seller's business. If it was from another investor, that clarification goes to the seller's account of the previous mortgage, not yours, unless you're taking a second position loan against it. This is the first position mortgage, this is second position for flipping loans. That's when that's what you're responsible for. But this one is not your expense. It's going to be the loan payment for the actual seller. Hope that makes sense. This is the little critical elements that if whoever is keeping the books, for the people who are flipping, make sure to keep those in mind. Awesome. Anything else I missed out on these flips or novations, Chris?
No, just one thing to keep in mind is that when you sit down, you're going to do novation. The bank is going to be at the table with you, so you want to make sure that they're kept involved, because if you just do it between the two of you and the loan transfer, the bank is, shall we say, they will have a conniption if you do something without letting them know what's going to happen. So keep people involved, keep the stakeholders involved or informed as to what's happening, so you're not facing, I mean, that's lawsuit territory there when you're doing that. So
yeah, definitely for the novation agreement, don't just pick something from the internet and stick it with your gown. But make sure for this agreement, make sure to sit down with the lawyer.
Exactly.
See whatever they recommend, sit down with them, bring whoever stakeholders that they suggest, and follow their guidance. That's another aspect, as Chris mentioned, is don't get into unnecessary lawsuit.
Exactly.
All right. Now let's go into the aspects of one of the biggest things people come up is real estate agents.
Yes.
All right, so I'm gonna bring two elements here because the type of their income. So say, for example, Chris, someone had this house, of course, it's better than the previous ones, but an agent comes in, they get an agent agreement. And in most cases, agents work under a broker.
Yep.
An umbrella organization. So whenever they make a commission of the sale to the final buyer, they get a cut as well from whatever the commission they have. So help us understand, how does this area comes out in terms of the taxes, Chris?
Okay, so Joseph, I'm glad we're talking about this, because as you said, brokers have real estate agents, and most of the time when you have a real estate agent, they're going to be working for a brokerage, and everyone's going to be called independent contractors. And what that means is that they're going to get commissions, and the broker's going to get their cut for basically housing the real estate agent. So what's going to happen is that something's being done through the brokerage office, and then I guess now the agent would be the ones getting the cut. So something to keep in mind, and I really wish that high schools talked more about this. I work a lot with hair salons, and I went to go in and talk with the cosmetology students. So I asked my salon clients and the community, what do I tell these people? I said, okay, make sure they understand the difference between a W-2 and a contract employee.
Yep.
Or contractor. Because what happens is sometimes you'll have somebody being treated like an employee and being paid like a contractor. And that's a big no-no with the IRS. That is huge. You could face significant fines and just shut down your business if that's going to happen. So what happens with that is, if the real estate agent they say, all right, here's your listing, go sell it. All right, well, I'm going to go do that. Independent contractor. And I'm going to simplify this quite a bit. But if the broker says, okay, here's the steps you're going to take, I'm going to provide all of this, and you're going to follow these rules, then you're an employee. So make sure that is clear and you understand what the difference is going to be. And that might be a topic for a future show that Tusif and I do about contractor versus employee. That's going to be the big one. Now, the thing about it is that if you're a real estate agent and you're a contractor, there's a lot you can write off. I have a one-page sheet of everything that you could write off as a business owner. It's 1 page, 3 columns long. It would blow your mind at all the stuff that you could write off.
Absolutely.
But the broker could also write all those things off, as well as the commissions that they're paying the real estate agent, because the broker's going to get most of it, then pull off a chunk and give that to the real estate agent as a commission. So that's going to be a deduction for that. Joseph, what other questions pop up that people ask about this?
That's one of the, you actually covered a lot of this, to be honest. Is one of the biggest things that people I actually have a lot of agent friends. One of the biggest generic questions has been, what as real estate agents can we do that? As a matter of fact, if you're an agent and an investor, there's something called real estate professional. We went over it a little bit. We will go a little bit more into it today, but if you're that, you can take unlimited depreciation. And if you are a full-time real estate professional, as Chris was saying, proper categorization, your income in real estate investment is, most cases, becomes active business. And one of the questions that comes, Chris, is what can we write off? So that's a very generic question. I know maybe you can take a couple of seconds to shed some light on that.
Well, usually what I say to my clients, and they're first bringing them on, is that, look, ask us, anything. I do have a one-page sheet, and, maybe Joseph and I can share it with you sometime, or for anyone who's asking for it. So just in the comments, say, hey, I want that sheet. Just we'll work out a way that we can get it to you. But so what I say to my clients is that, look, maybe you're out with your friends, and you always have that, you go out to a bar with one of your friends, and you have that one friend who always has too much to drink. And they'll come up to you and say, you know what, in your real estate business, you need to get an alpaca and use that. That'll be a huge write-off for you. So what you do is the next day you call Joseph Ryan and say, hey, can I write off the alpaca? You say, well, no, you can't. Where'd you get that? He tells the stories. Okay, he had too many. Maybe just nod and just then come talk to us. But really, those are the kind of questions we'll ask. Run something past us. There was a car commercial a couple of years ago about a CPA, and his client was like some big Hollywood star, and he was always trying to write off like elephants and tigers and stuff like that. He couldn't do it, but he got like a certain car. The car's like, oh, well, now you're being responsible. So really, it's going to boil down to things that you can use in your business.
Yep.
And there's going to be certain restrictions like on meals, what have you. But if you have your separate bank account, the 12th commandment is always go through your business bank account. Don't do things on your personal. That's going to be the big one. But if you're really thinking about a significant purchase, or thinking, well, I've got these things I'm thinking about, let me run this past Joseph and Chris and see what they say. So yeah, ask the question. We're never going to think that you're stupid. Stupid is when you get the letter from the IRS and you claim something you shouldn't.
Yes. So just to summarize, is what Chris is saying, anything and everything that is ordinary and necessary in your business is a write-off. That it means is, if something not ordinary, like alpaca or a Tesla for Chris's friend's pet walking business, that's not something that you typically write off. Let's face it. Now, however, for agents, some of the very common thing that I personally have seen is the vehicle deduction. They drive so much with people wherever their showing goes on. So all of that, trust me, real estate agents, I have seen someone write off almost $39,000. Think about it for a second, just on vehicle.
I can't imagine they're driving to New York and back every weekend. I mean, that's quite a bit. Yeah, but so, the thing is, if we can document the 5 rules: document. It's probably going to be a #1 hit next year. But if you can document it, like you have mileage apps like Mile IQ, great one. Just make sure that you've documented, because the IRS, you can put it down and say, here's where it is. They'll look at it and go, okay, by golly, 39,000 actually is what you drove.
Yes, and to be honest, she sold a lot of properties at that year because.
Well, good. She needs some deductions.
Yeah, I think they were pretty north of 400,000 or 500,000, but whatever. That was a good year for them, but she had to show a lot of properties. That's the case. So whenever you have all of those properties, you need to show those, as Chris mentioned. Mile IQ is one. QuickBooks has a mileage tracking app as well. if you're using QuickBooks. And if you're none of with those and you are old-fashioned like me, you can come in and figure out all the mileages with Google Maps, put them on logs. Make sure to do that every single day so that every single day you can do that. Another important thing I always remind people that people forget: when your car is primarily used for business, it can be depreciated as well. So you have this is on top of the mileage deduction. So you do have all of those mileages. Then say, for example, one of your real estate professional, you're a real estate agent, most of your mileage goes for business purposes. Say, for example, 90%, 95%, and you have a separate car for personal use. Make sure to have that depreciation taken as well. Especially, it allows you to take 5 years. Of course, if you're already taken depreciation 5 years, you cannot take more than that, because IRS already, in IRS's mind, it's already taken care of. So that's something that I would recommend. And similar things happen for wholesalers. The only difference is a wholesaler cannot claim himself or herself a real estate professional. Talking about W-2 and 1099, I forgot to discuss some of the things here. Is another big thing that I see flippers do is most flippers who are the general contractors of their thing, they sometimes mix this one up. If you hire a subcontractor who is exclusively indicating what to do to each of the worker, for them, it might be W-2. For you, between your general contractor, that is a 1099.
Exactly. Too. So the big thing that the IRS is, the word they use is control. How much control do you have over the people that are working for you? Now, like, people come and hire Tusif and I, we'd be independent contractors. There's not going to be anyone telling us how to fill out a tax return. And if they do, our rates go up extremely high. But because you're handing us the stuff and saying, okay, prepare the return. And then we give you back the return, and then we'll answer questions on it. We're independent contractors. But Tusif will tell you, he's had clients, they'll say, you need to do this, and this. Well, they're pretty much making Tusif an employee. And I've had that happen to me too over the last 15 years. Like, look, they didn't last long with me because, look, I'm a professional. You just go play with TurboTax and everything will be good. So that's really going to be the difference. Control.
That's a great point you brought up, Chris, is most of the time we forget there was another element. We were talking about another potential individual where they have a, what do you call them? Property management company. So the management company tells specifically what to do, how to do it for each individual property. But the issue is when they're paying it as 1099.
Mm-hmm.
And when I saw this, I just suggested that, hey, you might have a bigger problem in terms of deduction, because the moment, if you're saying what you're saying is you are told what to do, which date to do, how to do it by your company for what each management, and then they're giving you a 1099, that itself a red flag for IRS. So make sure to fix that up, and then we can have a deeper conversation on how to take it, because I understand that it's at the beginning, okay, you're making an unintentional mistake, but when you're talking to a professional, our duty is to remind you. And also in terms of flips, remember some of the elements that you are going to be going in. So say, for example, you buy in bulk and you're in the business of flipping, then whatever is excess is an actual inventory, not always an expense. So when I say not always an expense, it is an expense, but it's considered as an inventory in the books. Like if someone used to buy cabinets in bulk, you get a better deal. But you can only install so many cabinets in a flip, but you use them for the next flip. Even though you bought it for this specific flip, you need to realize that at the end of the year, you need to consider the holistic books as opposed to each individual properties, because otherwise each individual thing becomes a inventory for you. Chris, correct me if I'm wrong.
You're absolutely right with that, Yusuf. Keep going. You're on a roll.
Awesome. So make sure to consider those as inventory separate. And also, especially if you're having tools, if your tool is more than a year life, like if you have a drill machine, typically lasts a couple of years and more. Typically, that's the warranty you get. You cannot just go ahead and expense it fully at the same year, unfortunately. For tools that you use to do this work, in most cases, not all the cases, in most cases, you need to depreciate over time. What do you think, Chris?
I think you're absolutely right, Yusuf. Like I said, you're on a roll. Keep going.
Awesome. And of course, even though since this is not a capital property, if your main job is flip, you remember we spoke about basis on our 1031 exchange depreciation thing. This is not going to work for you. For your basis is the thing that you're buying. Now, for you, everything else comes into adding into the product as product cost. Since it's an inventory, the entire house is an inventory for you. Now, even though for a renter, you can take depreciation against those, for a flipper, that's not the case because you're not taking any depreciation. So for you, the entire thing, you need to divide each individual thing, each expense for each properties, get them into each properties and have those sales price, because that becomes cost of goods sold, not a depreciable asset. This is one of the biggest differences that I see between a long-term hold guy or short-term hold guy versus a flipper. Of course, for you, you might be saying that, hey, at the end, it's an expense for me. Yes. But depending on how you're filling your sheet up, what structure you're having, if you're having a management company for your active income, that might be significant. So that's why.
Yeah.
Go for it, Chris.
No, just keep going. I was affirming what you were saying. That's just something you need to keep an eye on. And again, just document the process that's happening.
Yes. And that's one of the things that I personally recommend is understand whenever you're into some sort of business, understand the basics of the books so that you're not at the end of the year, especially if you have not seen our first episode, go for it. Check out the episode because we also had spoken about different structures. And that structure is in turn is going to determine how you should be keeping your books and what type of books you're going to be keeping. Now, coming back from that to our wholesalers. All right, wholesalers, even though and brokers, both of them have similar option. Wholesalers cannot claim themselves as real estate professional. That is a big thing that differentiates. That's, I guess, you have to take credit because you're getting and paying for the education, continuous education license and all those kind of stuff. So agents make sure to keep those in there as well. But even though wholesaling is a business, wholesalers can still deduct all the expenses like pulling list. If you're reaching out, if you're driving, that's a business expense. But the only difference is if you're a full-time wholesaler, as much as I understand the law, you cannot qualify for that. As a matter of fact, I have if you don't know where to find it, this is where you find it. Let me share my other screen real quick where. Chris, how are you? Oops. This is the publication. If you go into it, am I sharing my screen?
I'm not seeing anything yet, Yusuf.
Okay, sorry.
We'll give it a minute. It's Saturday night.
Okay.
There we go.
So if you want to understand, just in case, hey, where do I really get absolute information? Go to IRS passive activity loss. This about publication 925. It's gonna pop up a link in IRS website. You can check out the PDF and also all revisions and associated links. This is where you have all the passive activities loss. Now, this publication actually speaks of what and how you can or cannot take things. As a matter of fact, this is where it says what activities qualify for real estate: develops or redevelops, construction, acquires, converts. This specific acquires it is something that is a gray area, I feel like, where wholesalers who are not licensed does not automatically qualify, but this point may help them qualify as well. What I meant by they don't qualify is that automatic qualification if it is a full-time job. But if this is a full-time acquisition, that might actually qualify for that as well. And for the real estate agents, that's brokerage of it. And same thing with property managements as well. If you're renting it, leasing it as well. So make sure to read this. I definitely recommend, even if you don't go through the entire thing, it's always good to check out the original source of it. And for a section 1245 property, it's pretty much something that's depreciable in many cases. I'm not going to go to the details of it. If you want, you can go into the IRS website as well. This is what it actually entails. And
well, one thing I always recommend to Sif is don't go through the PDF, do the HTML because it's a website. It's much easier to read. Always find that I have trouble keeping up with which column I'm in. So just a hint for easier reading for those of us that got a little more gray in our hair. That do the HTML, absolutely. You can make things bigger and it's much easier to search.
Yes. I will definitely recommend going through that. I'm not going to be going to the nuts and bolts on that now, but coming back to our whiteboard is if you are agents, full-time agents, you do qualify for rep. But if you're not a full-time licensed agent, but if you do work this full-time, you might still be able to qualify for that rep. And that actually is exception for this one. If you have not seen this episode, go back and check that out, where we did this chicken scrap of what it may be taken from a real estate professional thing, where that entire these two limitation does not fall anymore. All right. Now, just to summarize what we have spoken so far is we've spoken about the flips, the novations, the what do you call them? The agency and what the relationship are, real estate agency, and also a little bit of real estate management, and also the real estate professional, how you can qualify on a very broad scale. You need to have 750 hours of real estate related activity, actively managing it, and half of it, 50% or more, has to be absolute physical property related. Like it cannot be related to the time spent on networking or raising money, or maybe raising money, but not spend related to networking or primary education, those kind of things. So you have to be relating to physical properties. And of course, then it becomes your active income. Now, correct me if I'm wrong, is even though it allows you to take unlimited depreciation, if you don't have it, your real estate business becomes, if you're a single member LLC or doing it by your own, subject to FICA tax, which is 15.2%, which is Social Security and Medicare tax.
Exactly. And that's just something that you need to be aware of with that, is that you're going to, and business owners first time out and they're not really aware of it. Although a lot of times I've warned them that, hey, this is coming for your head, duck. Then just be aware of it. So then when you're doing our calculations for estimates, what have you, you just got to know that this is going to be baked in. And it's always a big surprise in April, like, where'd this come from? No, you're self-employed. And what it is that when you're working a W-2 job, your employer's already taken the employer's already has a match to Medicare and Social Security. So you don't see it, but you see your portion taken out. But now that you're out on your own, Uncle Sam wants their pound of flesh. So you don't have an employer, you are the employer. So you are going to be hit with those taxes. So
Absolutely.
Please just be aware of it.
Another thing is for Social Security, if you're making up to 147,000, that's the amount Social Security is going to be taxed at.
Mm-hmm.
But if you're making more than 250, if I remember correctly, it's 250 or 225. If you're making more than that, there is an additional 0.9% tax on top of that amount.
You are absolutely right. That's the net investment income tax.
Yes.
That's, I believe it's like 3.9%. If Congress hasn't changed it by the time this goes to press, as they used to say. So that's just, it's going to be something that you're going to be hit with. And I call it just the high earner tax because, or the rich dad tax, basically. Because you're out there, everybody remembers the book, Rich Dad, Poor Dad. The rich dad was out there making the moves. And because he had income coming in from other sources like we're talking about here, interest, dividends, capital gains, they're going to hit you with this tax. So just
Absolutely.
be aware of it.
So make sure to, whenever you're doing that, even though it sounds great, but unless you're able to reduce it to zero, but taking a lot of passive losses and bring it down to zero, you need to remember that these numbers are going to come and hit you. So make sure to consider that, hey, say, for example, at the highest level, this becomes 37%. Depending on the state, it's open. So if you are into some of the states like Texas, Delaware, you don't have to pay any taxes, good for you. But if you're states like New York or California,
oh boy.
I'm sorry about that, but you guys probably have been enjoying a good city life, but tax life is also something that you have to take care of it. And on top of it, if you're a single member, then Social Security and Medicare is going to come and hit you. So that becomes, so say, for example, if you're making 500 grand, like my friend the other day, you are going to be at that, I believe, if I remember correct, 37% is for $625,000 or $650,000.
I would say so, yeah.
W-2 range. Actually, and as a matter of fact, this also includes W-2 and 1099s.
Yep.
All the 1099s. So either it's 1099 interest, 1099 miscellaneous, 1099 NAC, whatever it is going to be at that rate. And top of it is going to be, so say, for example, make it worse. 8.1, I think, is California tax. Am I correct?
Chris, I think you're right about that. I've got a few California clients that we need to keep in their prayers because of all the stuff that happens out there. So yeah.
These two becomes a 15.2%. Of course, out of that 15.2, you can take write-off of half of it, which was supposedly would have been from your employer, as Chris was mentioning. For the people with W-2, this is typically taken care of by your employer, but now you have to do this.
And by what he means by write-off, and I've had to clarify this, is it's going to reduce your taxable income. Yes. That your tax rate is going to be on. So it gives you a break on taxable income, but the self-employment taxes is what we've been talking about. It's still going to be there at 15.3. That's not going to reduce that, but it will reduce the other taxable income that you're being hit with.
Yes. So make sure whenever, if you need further clarification, let's sit down and see where your income is, and we can talk about the exact numbers and how it works. But on an overall level, that's where you are. And if you are having other incomes like dividends, in stocks, bonds, and interest, you're going to be hit with that NIIT. We spoke about it in our previous video as well. Now, I'm looking at it, Chris. It's 37 plus 8 is
45%.
45, and add
Ooh.
another 15 is 60. We're looking at almost 65% tax in the US.
Yeah,
Think
that's
about that. I mean,
that's huge. I just when you sit there, you don't. Most people don't put it all together, but you sit, they go, "Wow!" So, I mean, there was someone a while back was floating the idea of making election day and tax day on the same day. The government would probably look a lot different if they had done that. So this is something to keep in mind, folks, when you go to vote, not just for like, we have the what I call the popularity contest in 2024, but most people don't really pay attention to the state and local races because it's not as popular. But these are the people who are going to set your real estate rates and the property tax rates. So please pay attention when you're going to vote. Don't just say, well, they're this party or that party, I'm voting for them. See what they're actually going to do. So I'm going to get off my political soapbox there, but please be an educated voter.
absolutely. And make sure that even if you're not planning for your money, 65% of your money goes away. And on top of it, you're going to have to pay VAT. Like every time you go and purchase in Virginia, it's 6%. If I were to buy groceries, that's about 6%. So that means 71%. If I'm a high earner, it goes to taxes. If you're still thinking, do I need a tax planner? I guess the question should be asking, am I okay with spending 65% of my money without in return?
Exactly.
So that is why I always say that, hey, let's have a conversation. Maybe we can, maybe we cannot help. That's okay. But if you're okay with 65% of giving it away, even before the other stuff, like you have to pay your car, you have to pay taxes on your house. We didn't talk about that. After this, you're going to be probably talking about car tax, property tax, yada tax. You're going to be left with only 10% or 15% to enjoy your money. So when you're a high income earner, make sure to leverage other tax preferred vehicles as well. Anything else you want to include here, Chris?
No, I think we've covered it. You just highlight the importance of some good tax planning and thinking about what's going to happen and the moves you want to make. So Joseph and I are here available to talk, happy to talk to you about it and see what can be done. Now, one thing I do run into, Joseph, is if you have a W-2 and a mortgage and you're looking for ways that you can, save money on your taxes, we're kind of limited. It's going to be the people who are the real estate professionals, who are the business owners that we can work a lot more with because there's more that can be done. If you're looking for a quick way, well, I've got a W-2 and a house, save me money on my taxes. Well, you actually have to do something in order to have those tax savings. Because first day of my tax classes when I was in college, what they said was a tax code was in there to encourage certain behaviors.
Absolutely.
And one of those is buying a house, giving a charity, and starting a business. So the tax code is actually encouraging those activities. So do as much of those as you can. Start a business. I've loved being a business owner on my own for the past 5 years. I've been doing taxes for the last 15. But consider that. And we're also available to talk. You're thinking about starting a business. Hey, let's kick this around a little bit. I love talking about this stuff.
Awesome. So 3 big points, folks. Chris just mentioned. I don't know if you're catching gem. Chris releases gem with his speeches. If you're not catching it, you're losing it. 3 big things. And on top of it, one of the biggest statements he made is tax code is not something that we are using to collect revenue. It is something that we're using to influence some behaviors. And the 3 behaviors we are looking into is business, investment into real estate, and charity. If you're into any of those, of course, we can also talk about some of the charitable aspects in the next few videos. We are going to be talking about foundations, charitable organizations, how you can possibly even take up 60% cash contributions. But in terms of what you are given tax breaks on, these are the limits. As a matter of fact, that third part might even be the legal way of a lot of tax breaks, which can not only be helping the society, but also helping yourself. We will be going through those as well. I know we have spoken a lot about a lot of these real estate elements. I would like to stop here on the real estate aspects today. And in the next ones, we will be moving into more on a business setting. And after that, we will be also focusing on the charity settings. These three are the big things, as Chris mentioned. If anyone is willing to take any deduction in this 65% or even 75% taxes, you should be focusing on these three key elements: business, investment into real estate, or charity. All right. Anything else you want to add, Chris?
No, Joseph, I think we've covered quite a bit.
Awesome. Yes. So just to summarize again what we have spoken about today, we've spoken about the flips, the novations, which is a creative way to flip. The second element is a very important thing is what's the difference between a contractor versus an employee. Even though you say someone as a contractor, if you are, the amount of control you have on them is going to determine if there is W-2 or 1099. That's a big thing that comes up. Also, we spoke about what the typical aspects of a real estate brokerage is and agents, and a lot of wholesalers that's out there that's making their first commission check or flipping the contract. And the fact that they're never actually holding the property, it is always an active income. There's no, even though you're dealing with real estate, there is no passive loss in there unless you're qualifying yourself by something else. All right. And we also mentioned and showed you guys how to find those elements. If you have further questions, you can definitely reach out to us as well. And for active incomes, this is the amount of taxes you can expect to pay. And for reducing, what you need to be actually thinking of is these two words. This is ordinary and necessary. And to reduce, what you need to do is this three elements: is focus your funnel of money flow through business, real estate investment, or charity. With that, I appreciate Chris for hopping on again on the Saturday night. Another thing is we might be switching our time a little earlier. We might be focusing on starting maybe half an hour earlier with 8-ish Eastern. So even though our poster might say at 8:30, we might look into starting at 8 o'clock Eastern, see how the response comes in. And if that helps out, then we'd probably keep it at 8. What do you think, Chris?
I think that's good. If people sit and listen to taxes at 9 o'clock at night, that's a good way to knock them out. But hopefully we can make it a little bit interesting and informative. So, and on that note, let me just say that we're not giving tax advice here. We're providing information. Please talk to your tax professional. Please talk to Tusa so that we can get you on the right track and see how this applies to your particular situation.
Absolutely. With that, I appreciate everyone listening and who will be listening later on. I appreciate Chris for hopping on again. And we are closing this one for tonight, and we will see you on the next one.